Okay, so it's 7:05. We'll proceed to start. My name is Judy Karagania. I am not going to switch on my video because we're experiencing a blackout at home at the moment, so there'll be no point to me switching on the video. Karibuni nyote. Today's talk is not clinical, it's financial, and I think it's important for us to just know how not just to make money, but also how to preserve it. And maybe if we are lucky to even learn how to pass it on to the next generation. So I invited someone who is a friend and someone I've worked with before. She's called Charlene. Charlene she's Charlene Wajiko Kimara. She's also known as Mama Bima Kenya on social media. She's a licensed insurance agent, financial educator and financial advocate whose mission is to help individuals and families achieve financial security. She has 8 years experience in investment banking and over 5 years in financial services industry. She specializes in protection planning, life insurance, income protection, medical insurance, and education planning. All these, I'm sure, ring close to all of us. She founded Mama Bima Kenya, an online community of 50,000 followers where she shares practical insights on money and wealth building. She's a two-time MDRT qualifier. So I found out that MDRT means $1 million round table. So I think it sounds like something we want to hear more about. Charlene, you'll highlight that. We want to hear about $1 million. So she's a two-time, not once, two-time qualifier of MDRT, the number 1 ranked medical insurance agent, and the number 4 ranked life insurance agent in Kenya. So we really have an expert with us today. She's also very, very passionate about simplifying complex financial concepts and helping Kenyans to take control of the financial future. And yes, so she will talk to us today and have a candid conversation with us on income protection, legacy planning, and annuities as a retirement option. So with that said, karibu sana Charlene, please take it away.
Good evening, doctors. Thank you so much. When Dr. Judy gave me a task, and it was very clear. She told me, Charlene, please come talk to us on matters income protection, legacy planning, and she also requested that I add a bit on retirement planning with a focus on annuities. Okay. Please, Dr. please confirm how much time do we have this evening?
So it's 7:08. Your presentation, I'll give you 40 minutes. Okay. Is that okay? Then we leave about 10 for question and answer. 10, 15 minutes for question and answer, so that we finish at around 8 or 5 is fine.
Fantastic.
Yes.
Okay. As you can see, I was really having fun playing, with words. I was very keen on using the clear vision for your financial future. Dr. Judy from the Word Go told me you'll not be facilitating the workshop for opticians. These are doctors. Yes, so my name is Charlene Kimara, as Dr. has said. Professionally, I'm known as Mama Bima. MDRT, that's the $1 Million Roundtable. It's an association for the topmost agents globally. And I'm now a two-time qualifier, and this comes definitely, with a lot of gratitude and joy, because it's really it pretty much says or talks of the kind of work that you are doing. I'm the first Kenyan insurance agent to be ranked as a COT. That's my qualification within that association. And COT stands for Court of Table. So yes, something that, I'm still trying to grapple with and still very grateful for. Within the industry, the Kenyan industry, at the Association of Kenya Insurers Awards that happened last month, I was ranked as the number 1 medical insurance agent in the country. And also I took 4th place in the life insurance category. And really, not really blowing my horn or tooting my horn, but speaks maybe of the passion that I really put into my work 5 years into this business, having done 8 years as a professional investment banker. Welcome. Today I'll be your facilitator for today's financial workshop. And I think it's important we start by asking ourselves, why is it important to have this conversation? Okay, that is for every ophthalmologist who's represented in today's conversation. So one, the key reasons why we are having this conversation, we want to understand the key risks that probably face you as doctors in the country, especially the key risks to your income, and also to learn how to structure or to do your inheritance planning. If you're very keen on leaving a legacy, this is one of the key reasons why we are having this conversation. And also just to look at what are our options. Once we hit that retirement age, how can we ensure that we can avoid old age poverty? So we'll be focusing on looking at how can annuities probably play a key role in ensuring that we have a constant income in our retirement. Allow me to start by saying this. Doctors spend their lives saving others, but often forget to protect their own financial health. A well-cared for doctor builds a legacy that heals beyond the clinic. Okay. One thing that's very unique about our Kenyan doctors, and especially the financial landscape, is one, as doctors, and from where I stand outside the medical profession, we definitely look at you as people who have high earning potential, okay? And of course, with that high earning potential, that also means that you are also highly exposed. You get highly exposed in the event, say, of a critical illness, in the event of permanent or total disability, or in the event of taking an early retirement. Okay, definitely the income of a doctor will face a higher exposure. Number two, irregular income streams. I think that is something also that's unique about our doctors. We have seen, and it's unfortunate, I must tell you, I think most of us grew up, and when we be asked what do you want to become when you grow up, the first profession we would say was, I want to become a doctor. But the reality on the ground is that it's unfortunate that our doctors, maybe in our country, are still faced with irregular, income streams, and unfortunately so. And because of employer decisions, we have probably seen our doctors, even income coming in very delayed, or going for months without income coming in. So we need to first embrace that, so that even as we are planning, we are planning for our unique situation as doctors. And lastly, possibly, maybe there's an aspect of delayed wealth building, because doctors take so much time, in school, and probably it takes time to really get to that point where you can say, now we are finally, earning like a proper amount of money. Dr. Judy, I had asked her maybe at what point maybe she would say doctors really hit their prime when it comes to income generation. And she told me possibly late 30s into 40s. Okay, so because of that delay in hitting your prime, in your income earning potential, that definitely would probably affect how you save, how you do your investments, or even how you do your protection planning. Okay, so how to do income protection. And at this point, first, I want us to understand, what do I mean by income protection or income replacement? Okay. When we talk of income protection, if you're a doctor, if you are a breadwinner, you have people who depend on you financially. So you could either be married, so you have a spouse, or you have children, or, in our unique African setting where maybe you do have even extended family members whom you are taking care of. Then how can you ensure that, God forbid, in the unfortunate event that, life throws a curveball my way, and this curveball could be in the form of either premature death, this could be in the form of a critical illness diagnosis, or in the unfortunate event of a permanent and total disability, how can I ensure that income is still flowing into my household, okay? Either in my absence or when I can no longer work at my prime and earn my income optimally, okay? So key questions to ask yourself as we think of how to do income protection, okay? What would happen if you became critically ill and couldn't work? Okay, so that's a rhetorical question to each and everyone in this call. What would happen if you're diagnosed with a critical illness? And what would happen if you become permanently incapacitated? Or lastly, what would happen if you passed away prematurely without really hitting your prime income earning potential? Okay, so going back to the concept of doing income protection, or what we call income replacement, let's first start by looking at how can we protect our income in the unfortunate event of death, okay, and especially premature death. It's very simple. You always ask yourself, for the people who depend on me financially, God forbid, if I'm not there, how much would I want to lock in for them month on month as an income? Okay, so let's work maybe with an estimate of 200,000 shillings. Okay, so you take the amount you'd want to lock in for your loved ones in your absence, you multiply that by 12. You ask yourself, how much is this amount annually? Okay, so in my case, if I'm locking in 200K for my family by 12, that tells me that is 2.4 million shillings annually. Then now we do what we call, there's a concept that we call in insurance the 10 times rule of thumb. Okay, so to protect your income in the unfortunate event of death, you need a life insurance policy with a sum assured or with a coverage of 10 times the amount you'd want to lock in for your family annually. So in my case, we were at 2.4 million. So you multiply that by 10 and it gives you 24 million shillings. And you may ask me, so Charlene, how would 24 million shillings then ensure that 200K has been replaced in your household? And it's very simple. In the unfortunate event that I pass away prematurely, and the insurance company pays my loved ones 24 million shillings, all they would need to do is invest this money in a low risk product. For example, a money market fund account, okay? So a money market fund is low risk. Your principal, if you are with a good underwriter with low brand risk, that already tells you your principal is guaranteed. So if you go for a money market fund, for example, giving a 10% net return, okay, that is after tax, 10% net, on the 24 million that has been paid to my family, that already translates to an interest of 2.4 million annually. Okay, so 10% of the 24 million, this translates to 2.4 million shillings annually. And if I divide the 2.4 million by the 12 months of the year, that already tells you we are back to the 200,000 that I wanted to lock in for my family should I not be there, and should my check, the check that I bring home every month, stop coming, then the life assured, like the sum assured that I have taken in my life policy, can replace that check almost perpetually as long as the sum assured or the lump sum payout is invested in an instrument giving 10% return. It's my hope we are together up to that point. Dr. Judy, you could probably chime in and confirm that we are together and I'm audible.
Yes, you're audible. We're together.
Okay, fantastic.
Please put in any questions you have in the chat.
Yes.
We'll go through them at the end of the presentation.
Okay. So for everyone who's seated here, you probably now have you definitely do have the number, that number that you'd want to lock in for your loved ones. So it's very simple math, as you've seen. It is that number times 12 times 10. Okay, so you can say now that is the amount of coverage that I need, to be able to replace.
Matthew, can you manage to mute Dr. Gohil, I think? Dr. Gokle, sorry. Oh, okay, he's muted. Continue, Shai.
Yes. So work with that number, with that magical number. So if your number is 300,000, so that already tells you need a cover that is worth 36 million shillings. If your number is 500, that's 600. If your number is 100, that tells you that is a 12 million cover, and so on. Okay, and we will actually get to see then just how affordable, because I could be talking of 24 million or 36 million, and you're probably thinking, I will have to leave my entire income. I'll have to, be giving my entire income to the insurance company. Not really. We will be seeing what type of policy you can use to do income replacement, and the goal. And one thing I always insist about insurance premiums are not meant to break bank, by the way. Insurance is affordable, and if you're using the right insurance tool, you will notice that it will be very high value in nature. So number 2, when it comes to income protection, so we've already seen how to protect your income in the unfortunate event of death. Number 2, how then do you protect your income should you be diagnosed with a critical illness? Okay, so in Kenya, you can purchase a critical illness cover from 500,000 to 15 million shillings. Okay, most underwriters will cap the coverage that you can have at 15 million shillings. Okay, and now the question begs, because you are doctors, and maybe this is also a rhetorical question that I'll throw to you. How much do you think, if one was to be diagnosed with a critical illness, say cancer, for example, how much would you estimate would be sufficient to take, a Kenyan from maybe the beginning of treatment to the very end? Would that be, is 5 million sufficient? Is it 10? Is it 15? You could put that in the chat also. I'd want to see the kind of figures, because every time I query a doctor on this, definitely the numbers are big. The other Kenyans, someone will tell you, I think 3 million is sufficient, 5 million is sufficient, and doctors definitely do give me a higher number. Okay, and if we look at it, I'm sure most of us represented here probably do have a medical insurance policy. Now, if you are, say, on an international cover, say Bupa, Cigna, definitely then you are well taken care of in the face of a critical illness, because these covers go to the tunes of even hundreds of millions. This is not coverage that you can exhaust for sure. But what is the place of a critical illness cover, even for that doctor who has like really ample cover in terms of medical insurance? The other group may be those who are covered by local underwriters. And which I know you have probably scanned through your local cover, you probably do know there are sub-limits. You may have a 10 million cover or a 2 million cover, but once you check through your sub-limits to look at how much would I be covered in the event of a chronic ailment, or how much would I be covered in the event of the first time, diagnosis of a chronic ailment, you will definitely see that the sub-limits really fall short, of the kind of money that would be needed to treat, to go towards treating or medical care for a critical illness. And this is now where a critical illness cover comes in. Okay, and the key difference between a critical illness and a medical policy is when your medical policy mainly pays to the hospital, to the patient care providers. That could be the lab. It will cater for all the costs, and it will pay for your drugs when you go to the pharmacy, etc. the critical illness cover pays out a lump sum to the policyholder. Okay, and this is discretionary money. At no point will the insurance company come to tell you, please give us receipts of the treatment or how you have utilized the money. No. So even if you have, say, very ample coverage from your medical policy, and you receive your 10 million payout, say from a critical illness cover, or your 15 million cover, or your 7 million, this already tells you when this money is paid out into your bank account at diagnosis, then you choose what to do with that money. If at that point, possibly, other than maybe your main government job, or maybe you've also been doing maybe some locum gigs here and there, in the face of a critical illness, it may mean that you're no longer able, to do all the different gigs that you are doing on the side. So your income could actually be impacted by that critical illness. In such a case, then you can, if there's an income gap in the home, and maybe the priority expense at that point is what? School fee, maybe for the kids and so on, you're still able to pick money from whatever payout has come in from the insurance company and expense as you wish. Okay, so when it comes now to income replacement, it's a conversation of more than just what would happen if I passed away prematurely. It is good to ensure that the tool that you are using for doing income protection also has additional or optional coverage in when it comes to critical illness. Okay, and thirdly, when we are doing income protection, it's also good to ensure that the financial tool that you are using to do income protection also covers you in the unfortunate event of a permanent or total disability. Okay, and this, we call this a rider within life insurance, because the solution that we'll be using to do income protection, I'll be proposing the use of a whole life policy. Okay, I'll explain to you what whole life means in a bit. So when you have an accident benefit within your life policy, it's usually two-pronged. Okay, an accident benefit will pay in the unfortunate event. Say you have a 15 million cover for accident. In the unfortunate event that you become permanently totally disabled, okay, and this could, the disability, once you go through the terms and conditions, you would notice it could be classified in different ways. It could be loss of hearing, it could be loss of speech, it could be loss of limbs, eyesight. It could also even be getting into an accident that leads to mental incapacitation or total loss of memory. Okay, so in the unfortunate, so that rider would pay in the unfortunate event of a disability. At the same time, it also pays in the unfortunate event of an accident that leads to death. Okay, so now that accident rider is paid in addition to the sum assured. You remember in my case, I had a sum assured that I was targeting of 24 million. So if I've gone ahead and taken an accident rider, say, of 10 million, and unfortunately I pass away from an accident, then my 10 million would be paid in addition to the 24 million, and that would be paid out to my nominated beneficiaries. So when it comes to doing income protection, there are two key tools that you could use. Okay, that is globally, we do have what is called term life insurance and whole life insurance. Okay, today I wanted us to really focus on whole life, and I'll tell you why. So globally, definitely a lot of people do use term life policies, but in our market, we are at a point where we probably have the best whole life covers that are literally a hybrid of term and whole. Okay, the beauty of using a whole life cover to do your income protection is that a whole life cover is permanent. Okay, with a term life policy, if you have taken a policy for 10 years and the insured risk does not happen within the 10 years, then that means on year 10, the policy terminates, and either you have to buy another policy to run you maybe for another 10 years or to run you for another 20 years. And you'll always notice at whichever point your policy terminates, it's 10 years later or 20 years later. So the premiums have also really skyrocketed, because remember, life insurance is priced as also a huge factor of pricing life insurance is the age, okay, the age factor. Now with whole life insurance, it takes care of that issue, because whole life insurance is permanent life insurance. So you are assured that if I lock in 24 million shillings, this benefit will be paid at whichever point I finally transition. I am guaranteed that this is wealth that I have already locked in my estate. Okay, and in our market right now, we have very differentiated whole life policies, what we call paid up whole life policies, where yes, you can pay your premiums for 10 years. Okay, then on the 10th year, you get a waiver of premium, but that policy is permanent. So at whichever point you finally transition, that benefit would still be paid out to your loved ones. Okay, so hence why I'm a key proponent of using whole life insurance to do income replacement, because in 2 slides down the line, you'll get to see beyond doing income protection, this whole life cover also allows you to build generational wealth, as it's a permanent part of your estate. Okay, so let's take a look at what would maybe a 30 million sum assured cover with a 7 million critical illness, 7 million accident cover cost if you are going with a term policy where you're paying your premiums for the next 15 years. So we have Dr. Zainab, 25 years old, her premium to lock in a benefit of 30 million, 7 million of the riders and paying the premium over 15 years, she would be paying 17,249. Dr. Mbithi at 35 years would be paying 21,635. Dr. Bet at 45 years old, he would be paying 36,138. And Dr. Mukiri at 55 years old would be paying 72,266. Okay. Another case study, if 4 more doctors taking 60 million sum assured, 10 million critical illness, 10 million accident cover with a premium payment term of 15 years. Dr. Nyamai, 25 years old, would be paying 32,764. Dr. Ongago, 35 years old, would be paying 49,34. Dr. Gashago, 45 years old, would be paying 68,175. And Dr. Karagania, 55 years old, would be paying 134,858. Okay, please note, for a bespoke quote, I'll get, once we do a detailed needs analysis, for example, now if you want a bespoke quote for your situation where you want to choose the number of years that you would pay your premiums, the sum assured that you want, the amount of riders that you wish, we'll be able to provide for you a bespoke quote. The reason of sharing this case study is hopefully to double down on the fact that life insurance is actually affordable. And of course, the earlier you get started, you know, then you are able to also lock in, you know, very significant wealth, and just at a fraction, you know, it feels like you're giving the insurance company very little money and also getting a huge payout at the end of the day, or being able to lock in very significant wealth. For example, let's work with Dr. Mbithi, who's 35, and contributing 21,635. So annually, that comes to 259,620. In 15 years, that means Dr. Mbithi will have injected 3.894 million shillings into this policy that guarantees him 30 million sum assured, 7 million critical illness, and 7 million accidents. And something that I didn't even capture in this case study is that this particular, or the best whole life cover in the market, actually has an inflation guard, okay, where it accrues annual bonuses on the sum assured at 2.5% of the 30 million. Okay, so that tells you that each year, all these, the 4 doctors on our screen, their policies will be accruing a bonus of 750,000 to ensure that the 30 million is not being eroded by inflation. So in another 15 years, by the time they are done with their premium obligation, the value of their estate will not be 30 million. It will actually be 41,250,000. The critical illness and the accident cover will still be at 7 million, and they will still enjoy this coverage. For the riders, the critical illness and accident, this will be enjoyed up until when they turn 66 years old, while the sum assured plus the bonuses that will accrue for the life of the cover, not just during the premium payment term, those will be permanent up to whichever point the policyholder transitions. Okay, so now we have looked at how then can I use life insurance as an income replacement or an income protection tool. And this is what I was saying. If you use the right life insurance tool, it will also help you build wealth. Okay, in the past, people built wealth through, real estate, mainstream, maybe possibly mainstream investments such as shares. Some of the traditional tools of building wealth and an inheritance are also becoming a little bit tricky, maybe for the younger people to really acquire, because at this point, if you want to build an inheritance and use, say, land, already it's very capital intensive. Okay, so life insurance can be an alternative way, or you can also use it to complement the other mainstream investment tools that you are using to build an inheritance. And if you use the right product, such as a whole life cover, because this is permanent, what your whole life policy will do, it will be able to inject immediate liquidity into your estate. Okay, it ensures that your family or your loved ones and your beneficiaries receive a tax-free lump sum, okay, once the claim is made, and whole life never runs out. So if there's a key word that I want you to take as you leave today's financial workshop, is that whole means permanent. So you are sure whatever I inject into this policy, it will eventually be paid. It must be paid. Okay, and if you would now combine this, whole life policy and all the other wealth that you are using to build an inheritance for your loved ones, and then you combine that into a trust, okay, then you're able to really lock in and ensure that you have a proper estate where you've even defined how the distribution of your wealth will be done. Okay, so now we don't have much time. I see we have about 11 minutes, and I still want us to give some good time to the discussion on annuities. Please, Dr. Judy, please confirm that we are doing well and we are following the discussion.
Yes, we're doing well, a bit pressed on time, but yes, I'll allow you the 11 minutes.
Thank you. Thank you,
I'm
Doc.
seeing some questions are coming in. We'll answer those in the Q&A at the end. So just keep them coming.
Okay, thank you. Thanks, Doc. So Doc requested that I also touch on retirement planning and annuities, and hopefully at a future date, we could give retirement planning a whole session on its own. Retirement planning, a lot of us equate retirement planning to a discussion just on pension, but retirement planning is actually very broad. Okay, it's more than just pension. Retirement planning, we need to be talking about how about our post-medical retirement fund. That is, once I retire, how will I fund my medical cover, in my old age? Retirement planning also encompasses our living situation, that is in terms of your retirement home. Retirement planning also touches on actually your inheritance planning. What have you put in there? A retirement planning, a proper retirement plan should also touch on your estate planning. So what have you put in? A lot of us still go the way of wills, but how about considering how can I set up my living trust, or private trust, or even how can I start off, for those of us who do not have that lump sum of setting up a trust, can I also even start by using a trust fund? And as you know, in the market, for example, a trust fund, say if you're going through a trust company such as ICL Lion Trust Company, with just 5,000 shillings, you'll be able to set up a trust fund. Okay. And retirement planning, so we've seen it will also encompass estate planning, and also we cannot forget to talk of pension, which is what most people believe retirement planning is should mainly focus on. But retirement planning should be very broad, maybe on a different date. We could talk about that. But today we will be narrowing our discussion in on annuities. Okay, and what is an annuity? If you've ever gone back to the village and talked to your teacher, I think teachers are some of the people who are successful in doing an element of retirement planning. And it's unfortunate that Kenyan retirees are ranked amongst the most impoverished or the poorest retirees globally. This was by a research done by research done by Allianz, the largest insurance company globally. They actually did realize, as Kenyans, we have not gotten retirement planning properly. But if you've met or talked to your teacher, and you ask them, Mwalimu, what are you doing nowadays? They will always tell you, mimi tunakula pension yangu after they retire. That product that they refer to as pension yangu, that is what we call an annuity. And it's basically a contract that you go into with an insurance company where you say, well, I was working, I was able to put together this 20 million or 30 million or 50 million or even 10 million or 5 million through my pension savings. Okay, and you bring in that lump sum and then you give it to the insurance company. And what the insurance company in turn does, they guarantee you that, Dr. Karagania, you have retired, say, at the age of 50. For as long as you live, even if you live up to 100 for another lifetime, we shall pay you X amount of money each month for the rest of your life. Okay, so that is the product we'll put a spotlight on this evening. And when we talk of an annuity, think of it as a way of replacing your salary, because at this point, you enjoy a salary every other month, okay? Hopefully a regular one, where on the 25th, this money comes in, okay? So an annuity is basically doing that. Now, in old age, when you probably do not have an employer, how then can you ensure that? There's my 250, there's my 500,000 that's still coming in, okay? And it helps to protect against outliving your savings. By the way, research by the Retirement Benefits Authority, which is the regulator of the retirement industry in Kenya, shows that most Kenyans spend our pension savings within the first 3 years of retirement. That is, if we receive, especially from a provident fund, if we receive our pension as a cash lump sum, by year 3, for everything we menda. Okay, so this is actually very unfortunate, just very unfortunate statistics. But what are the options? What options do we have when it comes to an annuity? Okay, so once you go to the insurance company and you tell them, I have accumulated a pension of 20 million shillings. Now I want you to give me a guarantee of an income every other month. And I must mention, although we are putting a spotlight on an annuity, there is also an option, okay, which you could say is the other side of an annuity, what we call an income drawdown. Okay. But now getting back to the annuity, you will have 4 options. You can purchase an annuity, okay, without a guaranteed period. I find this dangerous. I advise my clients against this. And basically what this means is, yes, I bring in my 20 million shillings and the insurance company tells me, we will pay you from your 20 million will be paying you 200,000 shillings for the rest of your life. Okay, but without a guaranteed period, what this means is, God forbid, should I pass away 1 year down the line, that's it. That contract now ceases, and there's nothing that would even be paid out to my beneficiaries or anyone I had nominated as a beneficiary. So without a guarantee period, it will only pay a regular income for as long as you live. Okay, now, and then we do have an annuity with a guaranteed period. And the guarantee period, the available ones in our market are 5 years, 10 years, 15 years, or 20 years. Okay. And basically what this means, I am a huge proponent of going, of maxing it out. Take a 20-year guarantee term. And what this would mean, for example, if I have traded in my 20 million for 200,000 every month, by the way, you will notice by year 8, I'll probably have, I'll have utilized pretty much my entire principal. Okay, because an annuity on average pays you 1% of the lump sum. So by year 8, in most cases, you'll have literally been paid the entire principal amount, but you still do have a guarantee that even if you are to live for another 40 years, for another 50 years, your 200K would still be coming in month on month. So an annuity with a guarantee period, if I take a 20-year term, God forbid, 5 years in, I pass away, there is still a 15-year guarantee in that contract. And what that would mean is the insurance company will calculate and say, we were paying Charlene 200,000 shillings every month. So annually, that is 2.4 million. And there's still 15 years to go on this guarantee, on this annuity contract. So they would now lump that, the 2.4 times 15, that takes us to 36 million shillings. And that is the payout that would be paid to my nominated beneficiaries if I pass away during the annuity contract, the guarantee period. Okay, I hope you're together. And I hope you do realize I had traded in 20 million, 5 years in. This annuity would pay 36 million to my loved ones. Okay, but now, past the guaranteed period. So I do 20 years, all is well, I'm still in good health, all is well, and say I pass away after the guarantee period. At whichever point now I pass away, then the annuity just ends and nothing is paid out to any other party. Okay, and then we also do have the third type of option you'll have with your annuity is an increasing annuity. Okay, so you can just have a level payout annuity where every month I'll be receiving 200,000 for the rest of my life, or you could take a pay, you could opt for an annuity that increases over the years. So with an increasing annuity, that means instead of maybe starting at 200, they would start me out maybe at about 170, but then that income grows year on year so as to guard against inflation. Okay, so that is what we call an increasing annuity. It could be increasing maybe at 3%, it could be increasing at 5%. And these are the options. By the way, at the point where you hit retirement and your insurance agent is sourcing for you different annuity options in the market, it's very important because all these options should be on the annuity quote. Okay, so that you actually get to choose. Do I want the annuity that pays me the highest, monthly income from the word go, or am I comfortable starting small and seeing this income grow over time? Okay, and lastly, we do have what we call a joint life annuity, so with an annuity, you can either buy a single life annuity or a joint life annuity. And single life, as I'm saying, I have my 20 million, I just buy a single life cover and I will be receiving my 200,000 month on month for the rest of my life. But if I have a spouse, even if they didn't have a pension, benefit, I can actually add them to my annuity and ensure that, God forbid, even if I pass away before them, as long as they are on my annuity, then the insurance company will continue to pay them, the monthly income for the rest of their life. So if you're keen on protecting your spouse also against old age poverty should you go before them, then a joint life annuity is a good option to take. Okay, so when you are getting your annuity quote, all these should be options that are presented on the write-up for you. Okay, and I would like to say, always ask for, show me how that individual quote looks like, show me how the joint quote looks like. You will be blown away by just how small the difference in terms of monthly payouts, how small that difference is between an individual policy and a joint life annuity. So I think this brings us, I can see it's now, I'm 1 minute past my presentation time, and I like to keep time. Yes, I think we can actually open the discussion to a Q&A. And I hand it over to you, Dr. Judy.
Thank you, Charlene. That was a very comprehensive talk, and I hope everyone has gotten something out of it. I'm seeing a few questions in the chat box. So the first two are actually the same.
Yes.
So it's a question from Dr. Mark Nganga and Dr. Dorothy. What if the insurance company collapses? What happens to the money?
Okay.
And then the second question is, if the premium increases with age, and I'm guessing this is in reference to the whole life, does it increase with age, or does the client pay the same amount as they paid at the beginning?
Okay.
Yes. These are the only questions we have right now, I guess.
Who asked about if premium increases with age, Dr. Who?
Dr. Vivian.
Okay.
Yeah.
Okay.
Please add your questions in
Dr.
the
Mark
chat,
and
or if you want to talk, you can raise your hand.
yes. So Dr. Mark, Dr. Dorothy, if the insurance company collapses, so we have seen the IRA, our regulator, the Insurance Regulatory Authority, number one, they are very keen when it comes to what we call long-term business. In the past, this is the practice within the life insurance part of the business. In the recent past, we have seen actually insurance companies collapsing and going through, being put under liquidation. We saw a company that was a favorite of the health insurance business, Resolution Health, just go under. And we've seen insurance companies struggling, especially on the general insurance side. But this you never get to see when it comes to life insurance, that is companies offering life insurance or pension. And this is what the IRA has done over and over again. Number one, you will start to notice that we do have a significant, many international companies coming into the market. Okay. For example, we did see, Old Mutual, a giant by their own right, come in, acquire UAP. We did see Sanlam, when Pan-Africa, the entry of Sanlam into our market was when Pan-Africa Life Insurance had gotten to a point where they were struggling, and the IRA invited the largest financial services provider and largest insurance company in Africa to come in and acquire that life insurance book and pay out maturities that Pan-Africa was actually having a difficult time paying. Okay, so they came and they bought the entire book. Okay, did you know that, by the way, in our Kenyan market, we have the 4th largest life insurance company in the world? Okay, Prudential Life Assurance. Prudential PLC is the largest life insurance company in the UK, and ranked globally, they are the 4th largest life underwriter. By the way, when I was focusing on my presentation, the whole life cover, the attributes of the whole life cover that I was talking about are things like the flexible premium payment terms, where you can pay for 10 and it's still permanent. Things like the policy that accrues bonuses, those are specific to the Prudential cover. Okay, so one criteria that I even use when we are talking about, when I am for a life cover for my clients, I am very keen on looking at.
Sorry, Dr. Kagondo, please mute.
Yes. I'm keen on looking at the health of the insurance underwriter, because when you talk of whole life insurance, these are policies that probably could even be paid 50 years, 60 years from today. Okay, so when I profile a company and if I go for Prudential, this is guided by their claims settlement ratio. If you go into the IRA website and just type in claims settlement statistics for life insurance companies in Kenya, you will definitely see that a company like Prudential is a class apart from the rest of the underwriters. You're talking of a claim settlement of anything between 96.3 and above. Okay, mind-blowing, where even mainstream and the most highest ranked underwriters in Kenya are at 75, yet this underwriter is at 96.3 and above. Number two, you're looking at a company that has been in existence now for 177 years. Okay, and a company that is just specialized in life insurance. So looking at the brand is maybe one of the factors that we try, because there's nothing really guaranteed, honestly, in the world, but then how can you reduce the issuer risk or the brand risk? Okay, but over and above that, we've seen very keen efforts. For example, how Prudential entered the Kenyan market. They actually came in to rescue a life insurance company that had just gone under. It was the life insurance arm of Blue Shield Insurance. We also Blue Shield Tank, and Blue Shield used to have a sister life insurance company called Shield Assurance, and the IRA invited Prudential to come set up office in Kenya in 2014. They rescued Shield Assurance, they took over the liabilities, and they have gone ahead and paid over 2 billion in maturities of the book that was held, of the policies that were held by Shield. Okay, I hope that answers you, Dr. Mark and Dr. Dorothy. Now, to Dr. Vivian's question, do premiums increase with age? And with the product that we were focusing on, okay, no. You will find there are whole life policies that will give you a level premium. So if you come in and you're paying 10,000, you're paying 30,000, that is what you will pay up to the premium end term, okay? Then you could be on a cover where your premiums actually increase. For example, allow me to mention names. Before the Prudential Pro-Life policy, the other most known whole life cover in the market was the Green Light by Old Mutual, where with Old Mutual, for you to have their Green Light, before you would pay your premiums up to the age of 80. 2 years ago now, they brought this, their premium end to now 75 years. Okay, but you can already tell, if I'm 35, if I'm 40, and I'm trying to buy a whole life cover, that means for the next 35 or for the next, 40 years, I am committed to paying premiums. I'm paying premiums even past my ideal retirement age, which is quite dangerous, because is it food, is it my medical, or is it my agent who's chasing after me telling me to pay premiums? Okay. Also, you would notice that the Green Light cover would actually, if you want to enjoy the inflation guard, if you want your money to stay ahead of inflation and it's accruing bonuses year on year, then your premiums would be increasing. So that's why it's important, even as you sit with an insurance agent, please make sure it's someone who has a view of whatever is being offered in the market. I would say the top 3 whole life policies in the market right now. Number 1, the Prudential Whole Life. Old Mutual still has their Green Light. Number 3, we've just seen ICA also launch their own whole life policy. So have somebody who can actually do for you even just a side by side, of how do these compare, so that you're sure that if you commit to one, you actually get the best. I hope that answers you, Dr. Vivian. So in this case, the policy I was talking about, it's a level premium for the premium term that you choose.
Okay, I think that was well answered. There's one more question from Dr. Dorothy. She's asking, how can insurance companies ensure that policies held by clients do not end up in unclaimed assets?
Okay. So how can insurance companies? So number 1, it's unfortunate. I believe, if I'm not wrong, I think now the unclaimed financial assets. The last time I checked, they had hit 75 billion. Very unfortunate, because that is just wealth that is lying there that should actually be in the hands of families. Okay. So one, what I like to encourage, especially my clients, and I hope I still get to answer you, Dr. Ari, is one, please ensure that as you take these types of policies, of course, a life policy is not something that you pretty much tell everyone, but have that one guardian, or even set up a trust fund. We talked of a trust fund even starting from 5,000 shillings. There needs to be somebody who knows. It could be, it could be your trust fund, so the company that's responsible for putting together your trust company. It could be a loved one whom you truly trust, that they would manage the affairs of your estate in your absence. It could be your lawyer, just whoever you choose. Okay, it could be your children, etc. So number one, please let us ensure that there is somebody, or there's an institution that knows there is this and this and that. Okay. Now, in practice, this is what I've seen for companies that are actually customer centric, because one way that your benefits could eventually end up with the unclaimed financial assets is if you have a running policy and possibly you pass away and the insurance company doesn't know that. And if it is what we would call like the endowment policies, the education policies, if now nobody comes to claim, at some point the insurance company can no longer hold the value that was in that policy, even if it goes, say, into paid up status. So good underwriters that are customer centric will really, you'll always notice when you're writing down your beneficiaries and your guardians, they will also be seeking to know what's your residential address, who can we reach out in the event, who's your contact person in the event of an emergency, or in the event some insurance companies even ask you, if we are unable to reach you, who else can we contact? Okay, so customer-centric companies will probably try and reach that third party before such, benefits are taken to the unclaimed financial assets, the UFA. So I am not yet sure that we do have a full, like a proper mechanism to ensure that that is not done. But as a client, what I would say, let there be somebody or an institution or somebody who knows that there is this and this within your estate. At the same time, when choosing your insurance agent, please also choose somebody, let it not be just transactional. This is somebody who will be checking. I've not talked to Dr. Judy in a while, or Dr. Judy is not paying her premiums. What could be the issue? So if I'm not able to reach Dr. Judy, then I probably do know maybe her spouse or someone, like I can reach out to somebody else just to check, is Dr. Ari good? Or I know where she practices. I could drop by just to confirm, is Dr. Ari all well? So that if now I come across, unfortunate, news, then I can also now report to the insurance company so that we can initiate the claims process. I hope that answers you, Dr. Ari.
Yes, I think you have. I guess that's all for the questions for now. The time is 8:03, so we're good on time. Thank you so much, Charlene. I think that was a really good talk. I hope we've all learned something. I really hope we take it up to ourselves to really not just have income, but also to protect it for our loved ones if and when we are not around. Feel free to reach out to Charlene on the contact that she had displayed. And if you missed it, you can always ask me because, yes, I already know her. Yes, in terms of announcements, the SGM was carried out on Tuesday, as most of you know, and it was, the agenda was successfully passed. And yeah, the next CME will be on the 8th of May by Dr. Atik on herpes simplex. I haven't been notified of any other announcement. Okay, I think we can come to an end of our CME tonight. Thank you so much for attending. Have a blessed evening and a good weekend ahead. And thank you again, Mama Bima Kenya.
Yes, and Dr. Ari, before you sign off, I I will share with you the slides for anyone who may want, to just peruse through again, and possibly just for the benefit of someone who's maybe very keen on the annuities. There's a very good write-up, an ebook by the Association of Kenya Insurers on annuities. So I will also share that resource for you to distribute. And lastly, probably just a write-up on the whole life policy, more details like the terms and conditions and all, so that if anyone now wants to reach out after that, we can have a better discussion.
Okay, thank you so much. So I will have all that with me, and I'll definitely share with anyone who will be interested. Okay, I think now we can leave and have a good night. Bye-bye.
Bye.
Bye.